Did Bitcoin just dodge a bullet, or is it heading for a bigger crash? The market's been a battlefield lately, leaving investors puzzled. In this video, I'm breaking down the wild price swings with hard data and on-chain insights, exploring how a shrinking economy is hitting crypto and what this off-the-charts volatility means for Bitcoin's future. Let's break down some insights from Glassnode. First, let's look at the bigger picture. Liquidity in the broader economy, essentially how much money is circulating, is tightening up. You can see this in the US dollar index, or DXY, which has been trending higher for months. That matters because when liquidity contracts, assets like Bitcoin feel the impact quickly. Since they trade 24/7, they often act as an early signal for what's coming in other markets. A stronger dollar tends to put pressure on riskier assets like crypto, and we're seeing that play out now. Over the weekend, we had a major development. President Trump announced plans for a strategic crypto reserve, a government stockpile that would include Bitcoin, Ethereum, Solana, Cardano, and XRP. The market reacted instantly, with prices surging higher. But that rally didn't last. Within days, it turned into a classic sell the news event. Hype drove the spike, then prices collapsed back below their pre-announcement levels. Bitcoin's holding up better than the others, thanks to its massive market size and deeper liquidity, which is the volume of buying and selling power that cushions big swings. Ethereum and Solana, though, have taken a serious hit, dropping over 50% from their cycle highs. It's been a dramatic ride. What's behind all this turbulence? Volatility, and a significant amount of it. The past 2 weeks have been chaotic, with prices swinging sharply amid an uncertain political landscape. If you look at Bitcoin's realized volatility, how much it's actually moving day to day, it's jumping. On the 1 week and 2 week timeframes, we're seeing levels above 80%, some of the highest this cycle. That's a clear sign of just how unsettled the market has become. Now, let's turn to on-chain data, which gives us a window into what's really happening. One tool I rely on is the URPD metric. It maps out where Bitcoin's supply is clustered, based on what people paid for it. After that initial drop below $86,000, we entered a zone where very few coins had traded hands before. It's almost like a gap in the market's history. The big test here is whether the bulls, those betting on a rise, will step in to support this level. A lot of coins were bought above $90,000, so those holders are currently in the red. Between the 26th of February and the 3rd of March, over 150,000 coins, about 0.76% of the circulating supply, worth over $14 billion, were picked up in this $86,000 range. Prices are starting to edge back toward the top of that zone, and it'll be telling to see if those $90,000 buyers use this as a chance to sell and cut their losses. Another metric worth exploring is realized supply density. This measures how much Bitcoin is concentrated around the current price, within a 10% range up or down. When supply is packed tightly like that, small price moves can shift who's in profit or loss, amplifying volatility. As prices fell recently, this metric dropped sharply, showing a major change in investor profitability. It's a strong indicator of how intense this volatility has been, and it could influence how people approach the market moving forward. Let's assess the damage. Bitcoin's tougher than most assets, but this sell-off still stung. It was the second largest weekly drop this cycle, only beaten by the yen carry trade unwind in August 2024. Even so, at 28% below its all-time high, this drawdown fits the pattern of this cycle. Compare that to 2017, when 30% drops were routine, or 2019 to 2021 with multiple 50% crashes. This cycle's drawdowns have been shallower, suggesting demand is still holding up relatively well. When Bitcoin takes a hit, studying investor reactions offers valuable lessons about sentiment. Across all wallet sizes, small to large, we've seen heavy selling over the last 2 months. That's a wave of sell-side pressure, and it's intensified since mid-January. Much of that selling is from people locking in losses. Realized losses reached over $800 million per day this week. The only bigger loss day was that yen carry trade event at $1.3 billion. It's a challenging time, with many exiting below their cost basis. To understand this better, let's look at the SOPA, the Spent Output Profit Ratio. It tracks the average profit or loss people take when they sell. For the first time since October 2024, losses are dominating. But here's a potential bright spot. If SOPA stabilizes near 1, the break-even level, it's a positive signal. Brief dips below that, followed by a recovery, suggest investors are buying to defend their cost basis, a trait we often see in bull markets. Short-term holders, newer investors, are feeling it too, posting their second worst SOPA drop this cycle. It highlights how tough this week has been for beginners and could mark a shift in market mood. Short-term holders' cost basis is another key level to watch in bull markets. It's like a guidepost for price. Its plus and minus 1 standard deviation bands act as a sort of ceiling and floor. Right now, they sit at $130,000 on the high side and $71,000 on the low end. This week, price slipped below the short-term holder cost basis of $92,000 and has been trading between there and the lower band for the most part. Anytime we test the lower standard deviation band, it presents an excellent buy the dip opportunity if you believe the bull market is going to continue. So, to wrap things up, the broader economy is throwing some challenges our way. Liquidity is tightening up as the US dollar index keeps trending higher, and that's putting real pressure on assets like Bitcoin. Since it trades 24/7, it's often the first to react, and we saw that with the quick surge after the strategic crypto reserve announcement. Bitcoin, Ethereum, and others got a boost, only to crash back below where they started. Volatility's been through the roof, hitting over 80% on the 1-week and 2-week charts, showing just how shaky things are. On-chain, the URPD metric flags $86,000 as a pivotal spot. Hardly any coins traded there before, so it's a big moment to see if the bulls step up to defend it. With supply packed so tight around these prices, even tiny moves can snowball into something bigger. And the selling? It's been heavy. Over $818 million in daily losses locked in as people bail out. Still, at 28% below its peak, this isn't as rough as the old 50% crashes we've seen in past cycles, which hints at some underlying strength. The 92K to 71K range tied to short-term holders might be where it finds support if the bulls can hang tough. And that's all for today's analysis. Want more in-depth insights on today's topic? If you prefer written content, join my free newsletter for exclusive analysis. Click the link in the description. Thanks for tuning in, and I'll see you in the next one.